I think we are at economic warfare. Everybody needs an enemy. So we've decided that China, Russia, whoever we want to be our enemy is our enemy. So we are economic warfare for the share of the pie. But the world is not, it's not actually a fixed pie. There's an abundance. And that abundance is the other economic warfare, which is technology. Right? That's happening at a massive scale. And it's going into space, it's going everywhere. So I know what drives liquidity. It's driven by the business cycle. And there are certain cycles that are forward-looking. The Chinese credit cycle happens to lead by about 18 months or 2 years. The balance sheet right now is what, $6.5 trillion. And it looks like it will get $7 trillion or so. And it looks like it will get to 12 to $14 trillion by the end of 2025. That puts asset prices massively higher than here, hugely higher.
Raoul Pal, the founder and CEO of Real Vision, shares his insights on a unique approach to significantly increase wealth, even as fiat currencies continually lose value. Despite the US dollar being the world's reserve currency, it has been on a downward spiral, losing an average of 7% of its value each year. Looking back over the last century, the dollar has diminished in value by approximately 96%, leaving us with just about 4 cents compared to its value in the early 1900s. This decline in value has happened during a time when the United States national debt and interest on that debt were much lower than they are today. With the current surge in debt in the US and other developed countries, there's a growing concern among experts that the issue of currency debasement will only worsen. For example, respected macro analyst and investment strategist Line Alden has highlighted the potential for a crisis that could severely weaken even the stronger currencies in the near future. Alden suggests that we might see the dollar's value decrease at a double-digit rate annually, leading to higher prices for assets, persistent inflation, and a widening gap in wealth inequality. However, it's often the wealthiest individuals who remain largely unaffected in such scenarios, partly because of government actions. The disparity in wealth became even more evident during the pandemic, as shown in a 2023 report by Oxfam, which noted that $42 trillion in new wealth was generated, with $26 trillion going to the top 1%. The Bloomberg Billionaires Index further illustrates this point, indicating that 131 billionaires more than doubled their net worth during the pandemic, with one billionaire in particular, Gautam Adani, increasing his wealth from around $10 billion at the beginning of 2020 to $110 billion by the end of 2022. In a recent discussion on the Impact Theory podcast, Pal, a well-known macro expert and former Goldman Sachs executive, explained how individuals could leverage the government's economic policies to preserve and grow their wealth amidst ongoing currency debasement. His advice is straightforward. Track the balance sheets of the Federal Reserve and other central banks. Their tendency to expand their balance sheets is a key driver of the business cycle and asset prices. According to Pal, by understanding this correlation, individuals can navigate through economic downturns and bull markets by investing wisely during low-price periods to significantly enhance their financial standing. We invite you to watch the enlightening clips from this discussion. Don't forget to like, share, and subscribe for more insightful content. Enjoy the video.
Hypothesis is that, okay, this is very observable. I think it's going to last, this relationship between assets and the central bank balance sheet because of the mechanism of debasement of currency. And I can forecast out what the business cycle looks like. And I also know the amount of interest payments that need to be made because they happened 3.5 years ago. And I can see how far the balance sheet's going to expand. So the balance sheet right now is what, $6.5 trillion. And it looks like it will get $7 trillion or so. And it looks like it will get to 12 to $14 trillion by the end of 2025. In the end, that puts asset prices massively higher than here, hugely higher. So we're looking at more than a doubling of the NASDAQ from here. We're looking at another gigantic crypto run. That's into 2025. So we're seeing huge moves that just come from the debasement. And I've gone through in the Everything Code article that I wrote for Global Macro Investor, which is my kind of premium research service. In that, I've gone through various ways of proving this all out. So that's what I think I can do. But your observation, I think, is really important. Okay, when people, I mean, I've sent this to quite a few people, and obviously the subscribers of Global Macro Investor are kind of the world's most famous hedge fund managers, asset managers, and I think it really shocked people and resonated with people. They're like, oh my God, everything makes sense now. And so once you see it, it all makes sense. Now, as it becomes more public as a thesis, and Mike Howell at Cross Border Capital has been talking some elements of this, liquidity, you can see liquidity becoming part of the conversation on financial Twitter and stuff now. What I think we'll probably do is create boom bust cycles. Again, you can't have the bust cycle going below the level of central bank liquidity because optically they make it rise. This is what people don't yet understand. But of course, the stock market should go down 90%. Can't happen. Literally can't happen because of the debasement. It's a money illusion. But what I think we'll do is see, hey, off we go to the races. That's what happened in 2018. 19, early 20, we actually diverged from the central bank balance sheet massively because people starting to figure out this game, which is the moment the Fed stop the tightening cycle, markets take off because they know that the probability of more cowbell, more central bank printing of money, more interest rate cuts is coming. And so therefore we get boom bust cycles. So the boom times are too big and then you get a bust. And people know that from crypto as well. The long-term trend remains intact, but we keep getting these huge booms, collapse, boom, collapse, but the trend is still up. I think that's what we'll see. We'll be more like the crypto cycle, which is pretty much what we've just seen as well. We had a big collapse last year, and now we're straight back into the boom as we're starting to forecast this.
Raoul Pal's investment philosophy centers on two key insights related to the actions of the Federal Reserve and other central banks. Firstly, he posits that these central banks are in a continuous cycle of monetary expansion, essentially printing more money, which in turn has a direct impact on asset prices. The correlation between central bank activities and asset price movements forms the foundation of his approach. The second aspect of Pal's analysis divides assets into three categories based on their performance relative to the central bank's balance sheet expansions. Some assets lag behind, others keep pace, while a select few, notably those in the Nasdaq index and certain crypto assets, significantly outperform. It's in these outperforming assets that Pal sees a golden opportunity. According to Pal, investing in leading technology stocks and cryptocurrencies is not merely a defensive strategy to hedge against the dilutive effects of monetary expansion. More ambitiously, it's a means to accelerate wealth accumulation. He specifically highlights top cryptocurrencies, like Bitcoin, as not only safeguards against the erosion of purchasing power, a phenomenon often seen with fiat currencies, but also as potential cornerstones for a future monetary system. This perspective suggests that while traditional assets might offer some protection against inflation and currency debasement, the real growth potential lies in the tech and crypto sectors. Pal's advice implies a proactive approach to investment, focusing on assets that not only preserve value, but also offer the potential for significant appreciation in response to ongoing monetary policy trends. Returning to Pal's interview, it's clear that his insights offer a compelling strategy for navigating the complexities of modern financial markets, advocating for a focus on innovation and digital assets as key to outpacing inflation and achieving substantial wealth growth.
With Bitcoin, I treat it as an asset that is going to protect my long-term wealth. And that sounds crazy when it goes up and down like it does, right? And you've just gone through that full first cycle and you're like, oh. But what you'll find is the low is higher than the last time it hit the bottom. And then the next low will be higher and each high is higher. Oh, it's in an uptrend. So I just don't need to sweat about the ups and downs. What I should do is just accumulate every time it's in a down cycle. Why? Well, because the down cycle is signifying that economic contraction is happening and that the world is slowing down and money's being taken out of the system, quantitative tightening, which is the opposite process, and assets fall. and interest rates are going up. So your disposable income's going down because your wages aren't going up enough and the interest rates have gone up more. So it's at that point, you know, the outcome is if economic activity is going to slow down, the next year, in a year's time, they're going to be printing money or cutting rates because it's very cyclical for the phenomena of this rolling of this debt. So therefore, you should be buying more at these points because then you've got the next upside cycle to come, which is what I've always said is it's the cyclical trend within a secular trend. So secular trend is something long-term trend driven by a large explainable factor. Bitcoin is an answer to the financial system, and over time, the number of users and people who become aware of its superpower, the more people move across. That is a secular trend of adoption. That's really important. The cyclical trend, the cyclicality, is the ebb and flow within it. So that's the boom bust of the economy. Not at a gigantic bust level, it's just a boom bust. Now, Bitcoin halving cycles correspond with all of this. Why? Is there some magic in that reduction of supply? Maybe. But Bitcoin came out exactly at the same time that all interest rates went to zero. They're all part of the same cycle. So every time we get into this economic cycle, it affects Bitcoin in the same way. But over the long run, the adoption, the secular cycle, means it outperforms everything. Because there's no secular adoption of the S&P 500. There's no secular adoption of General Electric, or that stuff's not really happening. Yes, there's an ongoing purchasing by 401ks, but that's really it. So that big mega trend is the observable trend that people can participate in, and it is going to more than offset what is going on with the debasement of currency. And that's to do with Metcalfe's law and the exponential trend of the adoption of a technological network or a technology itself. Great. So that's why Bitcoin charts over time just keep doing this. It's because it's exponential. The S&P 500 doesn't do that because it's not exponential. But the NASDAQ does. Most technologies do. And the reason why the NASDAQ keeps outperforming the S&P and keeps outperforming value stocks and makes people so angry is because it's all about the adoption of new technology. If you think about what's been driving the NASDAQ recently, it's the adoption of AI. Obviously, that's the fastest adoption of any technology in history. Crypto was the fastest beforehand, but this has eclipsed it. It's gone from, in 6 months, from basically 0 users to 100 million users in 6 months.
Raoul Pal's analysis brings a critical perspective to the forefront of financial discussions, highlighting the widening gap between asset appreciation and wage growth. His observation that the S&P 500, along with other asset classes like real estate, has become increasingly unaffordable for the average American over the past few decades, despite not increasing in real value, underscores a significant economic challenge. The stagnation of wages since 1972, when adjusted for inflation, starkly contrasts with the exponential growth of asset prices, making it clear why relying solely on income from wages to build wealth is increasingly untenable. Pal's critique of the traditional financial strategy of saving and earning through wages alone as financial suicide is a stark but compelling argument for the necessity of investing in assets. By investing in the stock market, even in indexes like the S&P 500, individuals have a chance to maintain, if not grow, their purchasing power over time. The emphasis on cryptocurrencies and technology stocks is particularly noteworthy, suggesting these assets not only offer a hedge against inflation, but also the potential for significant wealth accumulation beyond what traditional assets can provide. The everything bubble, fueled by the Federal Reserve's continuous liquidity injections into the economy, has undoubtedly contributed to this disparity between asset prices and wage growth. Pal's analysis, which he refers to as understanding the everything code, suggests that navigating this landscape requires a sophisticated approach to investment that goes beyond traditional saving mechanisms. By leveraging insights into the Federal Reserve's actions and the broader economic environment, investors can identify opportunities for growth that would otherwise be missed. I'm curious to hear your thoughts on Raoul Pal's analysis and the implications for individual investors and the economy as a whole. Do you think investing in assets like the S&P 500, cryptocurrencies, and technology stocks is a viable strategy for outpacing inflation and building wealth? How do you view the role of the Federal Reserve's policies in shaping these trends? Please share your comments and insights below, and don't forget to like, subscribe, and turn on notifications for more discussions like this.